So you're in a deal to buy or sell a small business, and there are debts that need to be paid in order for the business to be transferred over. And what if the business isn't worth much more than the debts? What if most of the money at the closing table has to go to pay off creditors? What if there's not enough money to pay the broker's commission? Stay tuned. That's what we're going to be talking about today.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it.
Are you a small business owner that's thinking about exiting your business now or in the next few years? My team and I are here to help with our unique zero commission program that we've been using since 2016. We can show you what your business is worth, prepare the package you'll need before you meet your first buyer, even run a confidential online advertising program for you just like business brokers do. And we'll coach you through the whole process, or you can hire us to manage it all for you, including coordinating your whole sell-side deal team. Head over to howtosellmyownbusiness.com to learn about how my team and I can help you get ready by watching a series of videos we prepared that explain each step in detail. And if you're ready or just curious to learn more, reach out to us and we'll get you started or schedule a call to answer your questions. I look forward to meeting you and learning more about your business. All right. So I've gotten a couple of questions about this topic, and I think it's because some parts of the economy are starting to slow down a little bit, and so we're seeing more and more people who are they're trying to do a deal, and the business that's being bought has some debts in it, and maybe the debts were taken off back when times were a little bit better. And now sales and earnings have gone down a little bit. And so the value of the business has started to fall. So if you can just imagine a business that might have been worth $1.5 million a few years ago with higher sales and profits, now is only worth $1 million. And during that time when things were going good, they took on like 800 or $900,000 of debt to finance equipment or inventory or whatever it was. And today the business is only worth $1 million, but they've got $900,000 worth of debt that is secured and guaranteed personally by the seller of the business. So what then happens on closing day if a buyer shows up and the buyer is going to make an offer and say negotiates the price down to 950,000, and the seller agrees because it's the only reasonable offer that they've received. They've got to pay off $900,000 of debts. They've got other closing costs like the broker's commission. Let's say the broker's commission is 10%, that would be $95,000. And then there's the attorney and other people, right? So in my example, $950,000 price with $900,000 of debt that needs to be paid off, there's only 50,000 left over there. And it's not enough cash to cover all of the different bills that need to be covered on closing day, such as the broker's commission, the attorney fees, etc. So what on earth do you do? What are the options? So it's an interesting question, and it's one that I personally faced when I was trying to do a deal to sell a daycare, and it was in an owned property, and there was a mortgage on the daycare, and it wasn't being run very successfully. The profits were down. There wasn't a lot of value in it other than the building, and the building had a really high mortgage on it. And so I was faced with this conundrum of how are we going to get this deal closed? Here are the options, right? So number one, either the deal is reformatted so that the price is higher and more money comes in on closing day. Now, why would a buyer agree to do that? After you've negotiated the price down to a certain point, that's the deal that you've made as a buyer. You certainly don't want to end up being asked to pay more just so the seller can pay their business broker, right? In fact, a lot of times a business broker, when they look at a situation like this and they are experienced enough to foresee where it might be going, they might not even want to take this file because they would realize, hey, I'm going to end up in a pickle trying to figure out how I'm going to get paid. So, what's another option? Well, another option is often that the price doesn't change, but the parties expecting to be paid on closing day come to some kind of arrangement amongst themselves to be happy with what's available. So, what does that mean? Well, the creditors might be asked to cut or take a haircut on their debts, but they likely won't agree to that because they've got security, probably in the form of collateral assets, etc., and they have a guarantee from the seller, personally guaranteeing the outstanding balance on the loan. So it's very unlikely that the lenders are going to agree to accept less than the $900,000 that they're owed, which then leaves sort of the trade creditors or the operational or functional creditors to the exercise, which are the attorney and the business broker. So there have been cases I've heard of where the attorney and the business broker just agree to cut their fees so that the 50 grand in this case on closing that comes in is split between the two of them, and both of them have to live with less, right? That's another thing that can happen. Um, Another way to solve this deal, if there's any degree of seller financing, which is part of it. Now let's amend our example just a little bit. So this is going to more closely mirror the scenario I had in the second deal that I was working on, where there wasn't enough cash on closing, where I think it was around $700,000 was the price, and the buyer was borrowing some money, and they put in some down payment money. And I think it was about $400,000 that they were putting down on the table. But the mortgage in this case, there was a building as well. The mortgage was about 375. So the purchase price was 700. There was a $300,000 seller note. And on closing day, there was only going to be $25,000 of cash. The cash covered the attorney's fees, but there was no cash to cover my fees. So we started to do some brainstorming here to try to figure out, how can I get paid for this deal if there's not enough cash? But we understood that there would be a stream of payments coming in over the course of time because there was a $300,000 seller note. So the question then was, do I want to then have to wait for the seller to collect payments and then for the seller to take some of those payments and give them to me? So there were a couple of different ways that we could address this. There could have been an assignment, which meant that the seller agreed that the first so many payments on that seller note were going to come to me instead of going to him, right? That would be one way of doing it. The issue, though, is that um, the seller note is subject to offset in the case of material misrepresentation or undiscovered liens or liabilities, which is a normal protection clause that I always teach buyers to ask for when they're doing a deal. So what that would mean was, I would be shouldering that guarantee as well, because if it did turn out that there was something wrong in the business and that the buyer legitimately had cause for not wanting to make those payments, then that stream of cash flow would be interrupted. They would stop making the payments. They'd be offsetting against the debt. I basically would have received an assignment of those payments, and if they were legitimately stopped, then I wouldn't be getting paid, right? So what then is the other option? Well, the other option that we ended up coming up with was that I lent money to the buyer. And so the buyer in that situation, by the time they were finished at the closing table, there was a seller note, which was subject to offsets in the case of, you know, material misrepresentations or undiscovered loans or leases. But then there was this other note, which was payable to me as the broker, and which did not have any of those offset clauses. So my note was payable according to a fixed time schedule of payments every month, regardless of what happened. And I was just like a bank. I had made a loan to the buyer. So in that situation, there ended up being two notes at the closing table. So the buyer borrowed money from their bank, which was the senior secured debt, which was part of the $400,000 they brought to the closing table, and then the 300,000 they owed later was then split up. So there was a much smaller note that was basically my commission. And I think it was payable over 18 months, perhaps. And then there was a much larger note, which was payable over 5 years, I think, for the seller for the normal kind of seller financing clause. And so, it was interesting because I then started to get these checks. And in fact, what the buyer did is they wrote me 6 post-dated checks at a time, just stopped by my office and gave them to me. And so every month I started to cash these checks. And I realized very quickly that it was kind of nice to have this regular stream of cash flow, especially in a business that is so much of a cash flow roller coaster. Like business brokerage, typically you get paid on closing, you get these big checks, but a lot of the time you're just taking that big check and you're paying off your credit cards and your lines of credit, et cetera, that you've accumulated since the last closing. And so with this new arrangement, I was getting a check every month, and it worked quite well. And so if there's anyone out there, buyers or sellers, that are looking at a deal and there are significant debts in the business, and you're looking at how can we figure out how to make this work, there are always ways to work it out. It just depends on how creative you want to be. Now, if you are a buyer or a business broker and you want to learn more about the technique I described, check out over on Amazon. I wrote a book about this, and when did it come out? Holy smokes, it's been a long time, that's for sure. Um, I don't see the publication date here. Oh, 2017 is when I published it. Here, let me share my screen. So it's called How to Borrow Money from Your Business Broker, and it's available on Amazon. And you can also get it from my blog site, davidcbarnett.com. Over at the blog site, in it, you just go under the Order Books tab. In addition to the actual book, you also get the audiobook version that I recorded, as well as a video walking you through the steps in the procedure. Because there's a certain series of steps that you have to do in order for the accounting to work out properly in doing one of these business broker advances to a buyer. But ultimately, what ends up happening when you go through this process is that the broker ends up in a position where they have lent money to the buyer, and it's the buyer that has control of the business, which is the source of profitability, cash flow, et cetera, right? What you don't want to do is have the deal close where you're still owed money from the seller because, the seller, if they're in dire straits financially, if they made this deal to kind of get rid of some of the debts, but they're still dealing with a mountain of personal debt or whatever, I mean, they can go bankrupt or something. And as the broker, you'd be a creditor to them, you'd end up tied up in that whole insolvency, which could mean that you ultimately may not get paid. So what you want is you want to have an interest in the performing asset, which would be the business, right? Which is making all the money. Um, it's in my mind, a couple weeks ago, I did a video about a roadway or a map to planning an exit from a business that isn't doing well. Um, it is often better to try to get a transaction which will at least clean up the senior secured debt, if you're a business owner and things aren't going very well. Um, that way, you get out from those big personal guarantees and everything. And if if it requires some degree of creativity in order to get it done, and it requires people to bend a little bit, I honestly think it's worthwhile doing. I have in my career run into people who would like literally block transactions that were going to really be helpful to get people out of a jam just because there would be a shortfall of a couple $1,000s on their commission, for example. And, in any kind of business, you're in business to provide for yourself, obviously, through helping to solve problems for other people. And if you can help get someone out of a jam, even if it means taking a little bit of a haircut on your commission, um, I think that what is required is a moment of pause just to think, what else do I get out of closing this transaction besides just getting the brokerage commission, right? Because there are a lot of other things that can come out of a transaction. Positive testimonials from buyers and sellers, The ability to advertise and promote the fact that you did another transaction, headstone publicity, let's call it. Um, you could create a name for yourself as somebody who has the ability to get difficult deals done, right? There's all kinds of things, fruit of beneficial nature that could help a successful business broker further enhance their reputation and practice through getting a deal done that might have trouble getting through under normal circumstances. Anyway, if you're a broker, or you've sold a business where one of these kinds of elements has come up, I'd love to hear about it. Go down in the comments down below, leave a message and explain the details of your situation and what exactly happened, and how you resolved it. I'd love to hear about it. Anyway, thanks. Keep the questions coming, and I'll see you next time. Cheers.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.